Good morning, February 11. Fabian Onetti from Winston Capital Advisors. There's the beautiful Vermont. Clearly, we have a lot to cover today, and we're going to focus clear on what happened last week more than our recollection of events, and try to come to a conclusion on the events that we witnessed last week and try to make sense of them and understand them. Since the election, the market was up 35% until the peak in January, and since then we are now officially in a correction. We have corrected more than 10%, and many things have come across, good and bad. A lot of pundits talking on the media, and clearly I did a lot of research, tried to get to understand where are we. So let's go here with the goods and the bads. I mean, let's I just made a T. And here what are the goods? The economy is doing very well, and growth on earnings is always very good. Remember, many companies reported very good numbers for Q4. We had a new tax bill that takes corporate taxes especially low. That's positive. There is global growth. This is not just a U.S. phenomenon. We have growth in Europe, Japan, rest of Asia, and emerging markets. The US dollar is okay. Usually when there is panic, we have big rallies on the dollar. Dollar bill been relatively stable after losing at the beginning of the year, a sign that the market was confident going elsewhere. And interest rates are also okay. Although this correction was triggered by a spike in interest rates, we'll get into that later. Since then, they have stabilized and not moved much farther. And more to the point, when you look at the spectrum of credit, high yield has been very stable. We finished last year with a default rate of 1.7% in credit versus an average of 4.2. So, this is consistent with a growing economy and companies doing very well. Valuations are okay. After the correction and the numbers that we have now, the S&P is trading at 16 times forward earnings, which is fairly much in line with historical valuations. And some markets like Europe, Japan, and emerging markets are even cheaper at 12 or 14 times earnings. And for the most part, the big money is okay. Talking to my friends on the street, as much as in credit, emerging markets, and institutional equities, no one shows big panics or big worries on the correction. Many people say, well, listen, the market's been rallying a lot. Not too bad. Okay, that's the good side. Let's go for the bad side. New taxes will create bigger deficits, so people are worried about that. We are finishing or getting to the end of quantitative easing in the United States and eventually in Europe and maybe in Japan. So this experiment that it has now, many years, and in Japan decades, it looks like it's coming to an end. So who's going to buy now the bonds that the central banks have been buying? Inflation, that's a big monster lurking beneath the waters, or maybe not. But clearly that's what triggered everything. The interest rates are going up by central banks. We have Canada, the United Kingdom, and the United States already raising rates. Maybe Europe at the end of this year, and maybe Japan. So clearly, a coordinated rate of raise by Federal Reserves or central banks will put a headwind to the economy. A lot of quantitative strategies, a lot happening with these VIX funds. No one really understands why, but the average volatility of the market is about 19. Last year it went all the way down to 10, and people thought that it was there to stay. So many people, sold that volatility thinking that was not going to go to 19. As these typical average indicators, they reverse to the mean. Eventually, that's what happened, causing a lot of distress. We have a lot of, pros and cons. I look into that. I see more positives than negatives. And what do I think will tilt the balances? Inflation. Inflation will be the thing that will worry the markets because it will create a perception of a Fed accelerating the raising of rates, and that will be negative. Where are we on that? We had this Wednesday inflation CPI. We expected 1.9%. Also, retail sales that not inflationary. It will be an indicator of the health of the economy, expecting 0.4%. And on Thursday we have PPI expected at 0.4%, and December was negative 0.1. So clearly the market will be ultra focus on these inflation numbers after we had the scare with the inflation of labor 2 Fridays ago. Unfortunately, if we had bad numbers, I think the reaction will be quite negative. People are very nervous. So maybe we should act earlier and reduce some risk positions. At this stage, I think I'm okay. Market corrected 10%. It rallied on Friday. I will take a look. I will keep very close to the market. And obviously, I will keep you guys informed if we think that we maybe should take some money off the table. I don't think so, because at the end of the day, I see more positives than negatives in the market. And clearly, I understand the nervousness of an inflation number coupled with the Fed raising rates. And, as I said, the global situation with central banks and quantitative easing coming to an end. But I think it's too early to overreact, especially in valuations and growth and the like. So we'll stay there. Let's jump to other things. So, couple of things to observe last week. The robo-advisors did very poorly. All the polls and the reading of the weekend shows that many people had trouble accessing and trading with the robo-advisors. Bear that in mind. Be sure that if you do robo, you have also real people that you can call on, not an 800 number. That's on one side. And the earnings front, we have a couple, which was Tesla, disappointed again, but Elon being the master of the show the day before releasing lousy earnings, put a rocket into the space with a car inside going to Mars, so everybody was happy. So here we go. Twitter, Snapchat, and Nvidia were the highlights, reporting very good numbers, and the market was very, very happy with that. So that's positive. What is coming this week? Remember, we're going to have a session of technical analysis on Monday afternoon with our analyst Gustavo Felici. If you care, let me know. And as I say, the big focus of the week will be, the CPI and the PPI. Like always, if you want more information, you'll find us on winston.capital. That was all. Have a great week. And again, we'll keep you posted on any changes.